third tenet, which I think we've touched on with the common
Yes.
enterprise.
But there's some gems to get into.
There are some absolute gems. And why don't you start off getting into that?
All right. So this third leg of the test is going to have two parts. The first part is reasonable expectation of profits. And then the second part deals with relying on the effort of others. One definitional convention to keep in mind here is the SEC refers to AP a lot in this section. That's dealing with the active participant. You kind of think of that as like the entrepreneur or the the leader of the project. So what they're looking at here is how much is the active participant or the leader how much are they providing managerial services that are keeping the enterprise afloat and ongoing, and how much do investors expect to derive profits from those kinds of efforts? And if there's a significant managerial effort, and if people expect to be profiting from it, that's going to engage the Howey test. That's going to fail the Howey test and make something, or render something into a security.
Can I say something real quick?
Yeah, go ahead. Sure.
Just on the expectation of profits, one thing that's important to remember is when the SEC throughout history and markets are determining whether or not people have profits, even when it comes to the original Howey test and the land and the oranges being sold and then the profits being distributed, what's always been distributed is money, legal tender. And what you don't have on any of these I say any, I don't know, but I'm sure there might be something out there. But for the most part, whether you might have a distribution of Algorand or a distribution of Avalanche or a distribution of Ethereum from some project that you may be able to use for different blockchain projects. But the idea that you get some type of distribution of money is not real. And we've already been over the economic reality, the fact
of why
that digital assets don't serve as money. So if I'm gonna, if I promise to pay you in game tokens for a game that I made that other people value and play, and you agree to that, that's fine. But I'm not paying you in money. That's different. You've agreed to get paid in some new volatile game token. So reasonable expectations of profits. I was going to mention one more thing.
Go ahead.
When it comes to virtually every proof of stake network or staking system that has a consensus mechanism of distributing a token over time, those are never considered profits. It's never been a reasonable expectation of profits for any blockchain that if Avalanche inflates at X% and you stake some Avalanche, that you will receive X% for securing the network, those are not considered profits. That's considered inflation, which is, ceteris paribus, the value would be going diluted over time. That's actually what's promised to people who enter into blockchain. They take such a high risk that they know they're going against the natural dilution to secure the network, but there's hope that despite that dilution, that the value due to supply and demand factors will make that negligible and worth providing support to the network. And I say that because Gary Gensler actually in the SEC actually leaves space specifically
for that.
To separate, he says, do not confuse price appreciation of supply and demand with profits. So as the SEC says on their own website and through their own perspective.
We're going to get into that. We're going to get into that point too, because that's one of the gems. But before we do, I think there is something that caught both of our eyes in this section. There's a subscript 12. You'll see the 12 right there. If you click on that, you'll find that there is a little reference to a court case, and one of the takeaways that's kind of that they're drawing your attention here to this.
It's actually a court case that we just got. It's actually the court case that we just got through going over. So you understand,
right?
This is right to the heart of the Howey test.
For sure. And I think the principle that's going to be elucidated is useful in a lot of ways, in a lot of places beyond just what they're doing here. So in this court case, they were looking for the meaning and the scope of the word security. in the acts that that established these laws. And what they decided is that the form should be disregarded for substance, and the emphasis should be on economic reality. So form is trumped by reality, which means that, naming conventions, the way things appear, is not as important as what's actually happening at a fundamental level of economic transactions, or what people perceive things, right?
I'm going to
So,
interrupt you real quick.
yeah, go ahead.
I'm to add to what you're saying, let you and throw it back to you. In other words, just because we call things digital currencies doesn't mean that we're actually trading in money and currency. Digital currency is just a form. It's not the economic reality. It's a word we call it because it's the easiest way to express being able to exchange something of value in the digital world. So let's just call it a digital currency, but that doesn't mean that it actually is currency, is serving as money, has ever been designed to be currency or money. And that's where we're getting into over the economic reality of blockchain crypto versus the form.
Right, exactly. And this insight is being focused on whether or not something is a security. It's saying, ignore the form, focus on the reality. And if we take that same approach to money, we ignore what you just said, the form that cryptocurrencies come in, and we just see that they aren't really currencies, they aren't really money. So this principle that it's really powerful, and I think it should be, it should not just be used in the narrow application, but this should kind of guide us as we think about these issues throughout the whole thing.
I dig it. That was a great point. Is there anything else under this
Yeah.
reasonable? There's a couple, I'm sure, actually.
Yes, I've got a bunch of little bullet points I wanted to go through here. So
Good.
when the SEC's has this is all guidance on how to understand whether or not something is a security. In terms of the reliance of others, there's a few bullet points that kind of jump out. I'm not going to list every one of them. You can go and read this yourself. We'll have links below. But some of the big things that jump out at you, and so we're talking about reliance on the effort of others, and profit from the effort of others. That's the subject here. And so what they look at is, does the purchaser reasonably expect to rely on the efforts of an active participant, like a leader or an entrepreneur or a manager, right? And are those efforts undeniably significant, essential, managerial efforts, which affect the failure or success of the enterprise, as opposed to efforts which are more ministerial or less important, right? The next thing they look at is the network or the digital asset still in development, or is it fully functional at the time of the sale? And can purchasers, do they expect the AP to further develop the functionality or not? Next, we look at, are the essential tasks or responsibilities performed and expected to be performed by the active participant, or are they performed by an unaffiliated, dispersed network or community of network users, known as a decentralized network? So that's a big one. Who's carrying out these essential tasks, and are they affiliated or unaffiliated with the project? Moving on, we're going to see if the active participant has a lead or central role in the direction of the ongoing development of the network or asset, and in particular, if the AP plays a role in deciding governance issues, code updates, or how third parties participate in the validation of transactions that occur with respect to the digital asset. So we're looking at how much control and management is at work here, and how much of it is a decentralized community of users that are handling these things, right? So the more decentralized something is, the less likely it will be a security. And so we're talking about, issuance, buybacks, token burns, things these are decisions that really have an impact on supply and therefore price, right? And so these kind of huge managerial actions, the more you see of that, the more likely the project is going to fall into that securities bucket.
I'd like to jump in real quick while you mention that, and let's go through these points and explain not just what they are, but whether or not it passes muster. I would say, does the purchaser reasonably expect to rely on the efforts of an active participant? One thing to note about blockchain and crypto, that many of the projects, is that the purchaser and the active participant are often the same person. The idea that these are two parties dependent upon the efforts of others is not true. The reality is that anyone who's interested in using, they believe that Ethereum or Algorand or Avalanche or whatever, name the chain, Cardano, has a value and they want to build on it, then anyone can access that code, hex or something else, and build on it, right? So the idea that you're expecting to rely on the efforts to increase value in your network isn't necessarily so. And just because a Vitalik or someone who may have a portion of tokens that gives them a vested interest in seeing it develop as well, isn't the same thing as having a corporation receiving funds and receiving money who is in charge of adding value to the network. Because in reality, when people acquire more of a digital asset, they aren't really sending any money to a third party and hoping that they will build out new infrastructure. And the reality is it's just a price appreciation from supply and demand, that if someone is a holder and has access to those digital assets, then they'll have more value there with which they can use and have access to, right?
Right.
But is it reasonable to expect on others for increasing value of the network of a public blockchain or of a third party foundation?
Yep. And then further on, they're looking at kind of the nature of, like, because there's oftentimes these foundations get projects, they launch them and they're completed, right? But then there's other times where you hear of, like, it's a roadmap and there's lots of development going on, and we have, we're this quarter, this is going to be launched, and we're working on that for next quarter. And so one of the takeaways here is that it kind of depends on how complete the project is and how much the active participant is being counted on to produce that value in the future, or if it's already a completed thing that functions in the here and now, right? I think that one of the takeaways here is that that's a big determination of.
And I think, mentioning that, I think many projects can be complete and still be in progress. In other words, projects can be built and complete and functioning so that you can use it, so that you can sign transactions, you can build contracts, but they also may still be developing to have improvement. Bitcoin is considered to be complete, and yet you still have applications, networks being built to make it more robust and to make it easier for adoption and more use. So the idea that changes or developments are happening does not preclude a blockchain from being structurally fundamentally complete and ready for market, so to speak.
And
are there any other
things that,
go ahead?
I was gonna say, one of the things that kind of shifts that one way or the other would be, who's doing the development. Is it something that's only done through the foundation, or is it this community driven thing where people are launching new, layer twos, and so clearly it's not a matter of one company that's in charge of all the blockchain, all Bitcoin development, or all Ethereum development. There's an ecosystem, an unaffiliated network or community of network users that is performing these actions. Many of them are managerial to the extent that they have very large influence on all parts of this, but the key is that they're not affiliated, right? This is an unaffiliated network. So to put it in the same basket with, say, what an Exxon or a Conoco is doing with their investments, it's really just, it's kind of disingenuous.
It's a lot of what we're seeing is that trying to apply securities laws to blockchain digital assets is the old, trying to force a square peg into a round hole. It's just not. They're not the same. And I was going to mention something else about that. Oh, right. The expectation of profits from the efforts of others. So something fundamentally to understand is that, like you just mentioned, when someone purchases a, a digital asset, do they expect to have profits distributed to them from, let's just say, Ethereum, for example? It's the biggest one. Let's just use that as an example. When someone purchases Ethereum, are they expecting to receive profits from anyone managing Ethereum based upon the success of Ethereum? In other words, if Vitalik or someone else creates a protocol that they make a lot of money from, do I expect as an Ethereum holder to be receiving some distribution of profits of Ethereum? And the answer is no.
Oh,
No one who purchases Avalanche, Algorand, Cardano, Ethereum, none of these decentralized blockchain networks operate to where, if the foundation, who of course they have an interest in increasing value, but they're not managing the profits of other people. If they create something extremely profitable or extremely valuable, do I expect that they're going to distribute a share,
no.
a pro rata share, which is what the SEC law says, that
Right.
there needs to be a pro rata distribution? So the reality is that on so many fundamental levels, do digital assets fail to meet the definition of a security, that we're really excited to share this information because I mean, clearly, but most people are just reporting the news and talking about and waiting, and we're hoping that we can get this information out there to help with the process and to
Yep.
promote a healthier environment for progress, for blockchain to flourish. And
Yeah. There's before we I don't want to cut you off, but I think there's one more thing we should touch on when it comes to reasonable expectations of profits. And this is in this SEC thing as well. So one of the things they look at is there's different ways profits can come about, right? You can have capital appreciation, which results from the development of the initial investment or the business. And then there's a participation in earnings resulting from those funds that have been invested. But then there's also, so that's sort of like profits that come from pooling money together and doing something with it, right? And then splitting up and distributing the profits based on how much people invested. So it's like a pro rata distribution. And then there's profits or what we call price appreciation, which results solely from external market forces, such as a general inflationary trend or some change in the economy. And this price appreciation is from supply and demand changing, and not because of something that the business did necessarily on its own inside. So it's an external effect coming from the market as a whole, whether it's a change in taste or a change in supply shocks, or maybe an inflationary trend that's going throughout the economy. Like, so these kinds of macro forces are not considered profit under the Howey test. So the price appreciation, yeah, that's huge.
Because most people, they assume they're guilty of failing the Howey test because they assume they've profited because, well, I got Ethereum, it was worth $300, and now Ethereum's worth $1,500, so I guess I've profited. But what they're not understanding is that, no, you just happen to benefit from the temporary price appreciation resulting from external market forces. And that's actually what underpins the value of digital assets across the board. It's actually supply and demand factors. So that for people to think that they are profiting under the same term as the Howey test, that's another reason why we mentioned. Hope you enjoyed that clip. Don't forget to hit the like button, subscription, notification bell if you want to get the latest drops. Of course, all of this is educational, entertainment information to help you in your journey, learning more about blockchain and how to participate. None of this is financial advice, investment advice. However, if you'd like to learn more about blockchain and crypto, we've got plenty of videos and playlists as well that walk you through DeFi tutorials, how to get involved. And if you'd like some more one-on-one help, check out our website, wisebeyondbitcoin.com. We've got plenty of free resources for you to scroll through and check out in your journey, your blockchain crypto journey. Of course, you can also drop us a line. Let us know what you'd like to learn about. Time is money, knowledge is power. Benefit from our experience. Let us know what you'd like to learn more about. We'd be happy to help you. Until the next time, have a beautiful day. Namaste, y'all.